Every resource boom follows the same script, and it always ends the same way. When a valuable resource is discovered, something predictable happens. Prices spike, money floods in, everyone believes this time is different, that the boom will last forever, but it never does. The cycle repeats so consistently across centuries and continents that it's almost mechanical. Let's trace how this pattern played out from the mines of the 1800s to the oil fields of the 2000s. Exhibit 1: The California Gold Rush of 1849. A laborer found flakes in a stream. Within months, hundreds of thousands rushed westward. Land that cost nothing suddenly sold for fortunes. Mining equipment manufacturers couldn't keep up with demand. Prices for picks, shovels, and pans tripled. Everyone assumed gold would flow forever. By 1855, reality arrived. The easy gold was gone. Deeper deposits required expensive machinery that most prospectors couldn't afford. Prices collapsed. Fortunes vanished overnight. The miners who'd arrived late, those who'd sold everything to fund the journey, lost it all. The camps emptied as fast as they'd filled. Exhibit 2: The Oil Boom of the Early 1900s. Gushers in Texas and Oklahoma made millionaires overnight. Oil companies multiplied. Stock speculators poured billions into new ventures. The price of oil stock rose so fast that ordinary workers mortgaged their homes to buy shares. They believed they'd struck wealth. Then supply outpaced demand. New fields opened, production soared, prices fell 70% in less than a decade. Speculators who'd leveraged everything watched their investments evaporate. Entire towns built on oil wealth became ghost towns. The pattern was identical to the gold rush, just with petroleum instead of gold. Why does this repeat? When a resource is scarce and valuable, early producers earn enormous profits. That profit margin attracts competitors and capital. New mines, new wells, new operations multiply, supply grows, prices fall. Marginal producers, those with higher extraction costs, go bankrupt first. Consolidation follows. Eventually, the cycle begins again elsewhere. The psychology matters too. During booms, scarcity bias kicks in. People fear missing out, they ignore warning signs, debt accumulates. When the bust arrives, panic selling accelerates the collapse. Those who entered late when prices were already high absorb the losses. Those who exited early keep their gains. Timing, not luck, determines who survives. So that's why resource industries boom and bust with such brutal regularity. It's not accident or mismanagement, it's structural. When profit margins are high, supply rises. When supply rises, prices fall. When prices fall, weaker producers fail. The cycle is baked into how extraction economics work. Understanding this pattern helps explain why fortunes built on single resources rarely last. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for more histories of the booms and busts that reshaped economies. There's a new cycle every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.